Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York. It is Thursday, October 20th, 2016, and this is the Daily Report for Gold and Silver. We have fractionally or modestly lower pricing in the precious metals across the board. A strong U.S. dollar is more than accountable for that, and of course we'll talk about that as we pull up a first chart. But to the boards, we do have gold trading off when we look at December COMEX futures off about $3, $2.90 at 1267.10. The low on the day has been 65.50 and the high 75.90. Once again, very tight range of about $10. Spot at 66.27. Low on the day 64.99 and the high 74.59. Again, that tight $10 range. In essence, we're looking at about a 0.2% drawdown on gold prices today. Over to silver. Silver trading lower. It is off a little bit more than a couple of ticks, so to speak. 17.53, putting it off about 13 cents on the day. The low is 17.45 and the high 17.73. And then finally, COMEX silver is at 17.53, off about 0.75%. And as I said, off about 13 cents on the day. Let's take a look at our first chart. So traders, the first chart that I do want to look at today is a daily chart, but I also want to first kind of touch upon the Kitco Gold Index so we can see the true picture of what gold has done today. Was gold down today? Absolutely down. Currently about $3 at 1266.70. The key, at least as far as I'm concerned, is the fact that we effectively have closed above 1266, because it's important to me on a technical basis that this particular price point become a supportive area for gold rather than a area of resistance. And that's right here. It is based upon a 61% retracement, and the retracement is a short retracement from roughly 1200 up to 1376. The second thing is that we want to acknowledge a dollar strength today, because when we take away dollar strength and simply look at trading in the market, gold actually traded up about 0.25%, up about $3. And we have to, of course, account for a very strong U.S. dollar, up almost 0.5%, 4.8 at this particular time when I took a screen print of this. And so due to a strengthening U.S. dollar, you've got to subtract $6.10, and that's where we get our net change of down about $3 on the day. Now, the same cannot be said for silver. Silver, lower pricing, and then, of course, lower pricing to a strengthening U.S. dollar. The same with platinum and palladium. All obviously are going to have the same net change in terms of dollar strength, but they were all trading lower. The only market in the precious metals to trade higher on its own before taking into account a dollar strength was gold today. And to me, that says that there is buying in the market and that this market wants to be supported in this particular area and price point. And so traders, the next chart I want to look at, this is the same chart we just had up. I've just converted our candlesticks to a Japanese average chart. And traders, of course, the key difference between a candlestick chart and a Heikin Ashi or Japanese average chart is simply the way the candles are drawn. In other words, on a candlestick chart, you're using a true open and a true close. Highs and lows are also factual. The high of the day, the low of the day, depending on, of course, the cycle. I'm assuming it's a daily chart. However, on a Heikin Ashi chart, you take the midpoint of the prior day and insert that as your open of today, and that is why you're getting the difference. So that when we look at this particular chart, you can see we've got all of the classic makeup, so to speak, of a market that has pivoted from a defined downtrend and moved into a defined uptrend. Take a look at this. As the market begins to trade lower, at first candle size is rather small. However, there is no upper wicks, which is what you look for. All that says is that at no time during the trading session did it trade at or above the midpoint. That's the lack of wicks. That's what it says. We have a lack of wicks, and then you get this increased candle size, meaning momentum to the downside is building. And then you start to get this decreasing candle size. You get the appearance of wicks. Let's go ahead and blow this up a little bit. But then you get the appearance of wicks, as I said, both upper and lower. You get this telltale doji. It continues to kind of solidify or consolidate. And then over the last 3 days, you have had these green candles. Of course, these are Henkin Ashi green candles, meaning that even though the market was down today, when we take a look at the midpoint of yesterday's trading activity and fix that as the open, at no time did we trade below of yesterday's midpoint, 1. And 2, we had a decent sized candle, but we also have a decent sized wick. So what we'd want to see is an increase in body size and the continuation of no lower wick. And that would really give us a strong indication that this uptrend was still intact. My recommendation is to obviously maintain our current long position, maintain our current stops where they are. I am looking to move our stops below 66 if and when we see this market have solid support and break solidly above that. That's going to be our next stop placement move, so to speak. For right now, we're keeping it where it is. And traders, lastly, a quick look at silver. This is a weekly chart. In fact, let's go ahead and convert it to a daily. But even with our daily, we're still below that critical trend line that we have identified as a support line. It actually fills in a little bit better when we look at a daily chart. I just like to look at weeklies when I look at the big picture, so to speak. But if we're fixing it, fixing it from these 3 lows and extending it, you can see that at no point have we even threatened this particular trend line right in here. And we really, as I said the other day, I really need to see a break above this to get bullish in silver. Currently, we are sidelined in silver, long in gold. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Have a great day. Bye-bye.